Thank you so much for joining me in this Options Trading for Beginners video. This is your complete guide to options in the stock markets. This includes call options, put options, covered calls, and cash secured puts. If you want to become a more powerful investor in the stock market, then watch this video. This knowledge will level you up. Now for this video, I want to tell you, no rush, take your time. There's certain parts of this video that you're going to want to rewatch, and it's most likely going to take you more than one sitting for you to digest all of this information. That's going to be normal. So please subscribe, and we're going to start with call options. Okay, so let's break this down to the fundamentals. So what are options? Options are simply contracts. They're options contracts. So it's essentially a deal between you and another person. So I want to show you this from the perspective of the buyer. So in our example, you will be the buyer of the options contract. And again, this is a call option. Now we'll just pick any stock. And in this example, we'll use Yelp stock. So the price of Yelp is at $35.84. But to keep it simple, let's just round it up and say that Yelp is at $36 a share. So what if I tell you, I'll give you the option to buy Yelp at $38 a share in the next 30 days. And for you to have that option, you pay me 80 cents. So is that a good deal or is that a bad deal? Well, honestly, it's hard to say because we don't know if the stock price of Yelp will go up or down in the next 30 days. But let's just say that you buy that contract for 80 cents. And now you have the option to buy Yelp at $38 within the next 30 days. So here's how you win. The price of Yelp right now is at $36. So let's say that within the next 30 days, the price of Yelp hits 42. Then in this situation, you're going to make good money because here's what's going on. So the options contract that you bought was a call option. So you paid for the option to buy a stock at a certain price within a certain amount of time. Now in our example, Yelp hits $42. So you have the option to buy Yelp at $38. So would you buy Yelp for $38 in this situation? So the answer, well, it should be, of course you would, because you could buy it for $38 and then immediately sell it for the going rates of $42. And then you end up with a gain of $4 a share. So here's what your profit would look like. You buy Yelp at $38, you sell it for $42, but you have to remember that you paid 80 cents to have this option. So you net a profit of $3.20. And I want you to know that this is a real life example. You could take a look for yourself. So this is the Robinhood platform. So all platforms will look pretty similar to this. So you see at the bottom right where it says trade Yelp options, which I outlined in red. So you click on that and it takes you to this. So I just want to say, don't be intimidated. I'm going to walk you through this and it's going to be very easy to understand. So these are the options contracts at different price points. If you want the contract to be at 38, then 38 will be your strike price. So as you can see here, you're going to see the options contracts with different strike prices, 35, 36, 37, 38, 39. That's just a limit of my screenshot. So you can go for an options contract with a strike price at $50 or even at $20, but I'm going to explain the difference to you in just a little bit. But for right now, let's just focus on you buying the call option at a $38 strike price. And take a look for yourself. That options contract is selling for 80 cents. So was our example of Yelp going to $42 in the next 30 days possible? Well, take a look for yourself. So I've highlighted in red in the top left, Yelp has gone up by almost $7 in the past 30 days. Now let's go back to the topic of you winning and making money. So Yelp is at $36 currently. You bought the call option with a strike price at $38, and that option will cost you 80 cents. So if Yelp goes above $38.80 in the next 30 days, then you're going to be at a profit. So maybe, who knows, Yelp could go up to 40, it can go up to 42, maybe 50, it could go to 100. I mean, that would be unrealistic, but it's not impossible. If Yelp skyrockets, then you're going to make so much money because you're going to have the option to buy it at 38. So if you buy the call option, then you want Yelp to go up as much as possible, as fast as possible, because if you think about it, it's very straightforward. If Yelp goes to $100, You can buy it for 38 and then sell it immediately for 100. So I just want to point out that that's the happy scenario where everything works out and you make a lot of money. But we have to talk about the flip side of the coin. We have to talk about how you can lose money and how you can get absolutely destroyed. So the danger is that you have a limited amount of time before your contract expires. And in that time, if the price of the stock doesn't do what you want it to do, in that set amount of time, then you're gonna end up with a worthless contract. So I have to show this to you. So here's how the unhappy scenario plays out. Yelp is at $36 right now. You bought the call option to have the option to buy Yelp at $38. In the next 30 days, if Yelp is at $38 or below, then your contract is worthless. So I want to demonstrate the good and bad scenarios for you. There are 4 scenarios. So here's scenario number 1. Yelp is at $36 a share currently. You have the option to buy it at $38 within the next 30 days. And let's just say that the stock price, it goes down to $30. In this scenario, your contract is terrible. It's worthless. Why would you use your contract to buy Yelp at 38 when you could just buy it on the open market for 30? And remember, you paid 80 cents for that contract, so you wasted your money and you lose. So here's scenario number 2. Yelp is at 36. You have the option to buy it at 38 within the next 30 days. And let's just say that the stock price, it goes up to 37. In this situation, it's the same. It's the same thing. Why would you use your contract to buy Yelp at 38 when you can buy it on the open market for 37? So yes, the price of Yelp stock, it did go up. It went up from 36 to 37. However, it didn't go up enough because it's still below the strike price on the contract. So you wasted 80 cents to buy that contract. The stock went up, but not enough, and you still lose. Moving on to scenario number 3. So Yelp is at 36. You have the option to buy it at $38 within the next 30 days. And let's just say that Yelp goes up to $38.50. So in this scenario, you can buy Yelp for $38 and you could sell it for $38.50. So that is a gain of 50 cents. So congratulations. However, you still lose money because you paid 80 cents for the contract. So your true cost basis, it's $38.80, and you can sell it for $38.50. So you still lose, but at least it's not a total loss. So here's scenario number 4. So Yelp is at 36. You have the option to buy it at 38 within the next 30 days. Yelp goes above your cost basis of $38.80, and then you're gonna be at a profit. And the more it goes up, the more money that you'll make. So basically in this situation, you want the price to skyrocket. For example, the best news would be Google decides to acquire Yelp for $60 a share, and Yelp stock, it skyrockets in price within your 30 days. Now, here's the thing. I want to tell you this because this is so important. With call options or options contracts in general, you can buy and sell them just like a stock. So in our example, if Yelp goes to $60 a share, you don't literally have to buy Yelp for $38 and then sell it for $60. You can just sell the options contract itself. But if Yelp is at 60 and you want to buy Yelp for 38 and just hold on to it, you can exercise the option and buy it for 38 and just hold on to the stock. And then your options contract, it'll disappear from your account, and then you'll end up with the Yelp stock. Now let's go back to the options screen. So I want to explain this whole option chain to you. That's what they call this. So you can buy call options at different strike prices. So let me tell you what is going on here. Okay, I want to ask you a question. It's pop quiz time. So I'm going to give you 2 offers. You tell me which one sounds better to you. Yelp is currently at $36. So here's my first offer. In the next 30 days, I'll give you the option to buy Yelp at 38. And my second offer, in the next 30 days, I'll give you the option to buy Yelp at 39. So which one sounds better to you? Of course, option number 1 sounds more appealing because I would rather have the option to buy Yelp at 38 instead of 39. Therefore, the contract at 38, a $38 strike price is more appealing. Okay, but here's the thing. These circumstances, they're factored into the price of the options contract. Now, I want you to compare the contract at 38 versus 39. The contract at 38 is selling for 80 cents. The contract at 39 is selling for 55 cents. So if you want to buy a contract with a higher strike price, the contract will be cheaper. That's because it's less probable that Yelp will hit 39 compared to 38. So in this case, they need to offer you a cheaper price. So take a look at the $37 strike price. That's trading for $1.15. That contract, it's more expensive because it's not that far-fetched that Yelp will go from 36 to 37 within the next 30 days. Now, I want to teach you about the duration of the options contract. So if you're thinking that this whole thing, everything that we're talking about, if you think that it sounds risky because, well, you don't know what's going to happen in the next 30 days with Yelp stock. If that's how you think, then I would say you're absolutely correct. I would agree with you because 30 days is not a lot of time. But what if I told you that Yelp is at $36, I'll give you the option to buy it at 38, but I'll give you that option for 7 months. So that scenario, it would be more appealing to you because you have more time for Yelp to go up. However, those favorable conditions, they're taken into consideration. Therefore, if you want more time on your contract, then you're going to pay for it. So take a look for yourself. I circled at the top your ability to choose the expiration dates of the contract. So we're using the same strike price at 38. For a contract that expires in 7 months, this contract is going to cost you $3.90. So compare that to the contract that expires in 30 days that's going for 80 cents. If the expiration date of the contract is sooner, then the contract will be cheaper. If the expiration date is farther out, then the contract will be more expensive. Now, I must clarify this one last thing because it's very important. Options contracts are for 100 shares. So if you buy one options contract of Yelp at a $38 strike price, then you're buying the option to buy 100 shares of Yelp at $38. And the contract price, it's quoted at 80 cents, right? So that's 80 cents a share. But you have to remember that you're dealing with 100 share increments. So if the options contract says 80 cents, then the options contract will cost you $80. So if you buy 5 options contracts, it's going to cost you $400. Now, I hope that this has helped you to better understand call options. Now, in this next segment, we're going to proceed to covered calls. So covered calls, we're still going to be dealing with call options, but we're going to be taking it one step further. And this will help you to decrease your risk and generate passive income. So I'm going to explain to you why stock market investors love covered calls, and then I'm going to show you how to do it. If you think that covered calls are complicated, they're not. I'm going to break it down for you nice and easy, and then you're going to become a much better investor in the stock market. And I just want to say that personally, I'm a big fan of covered calls because it gives me a steady stream of income. Now, let me tell you the good and the bad of covered calls. So the good thing about a covered call is that you will be paid income. Now, this could be weekly income, it could be monthly income, annual income. It's your choice. You get to decide. You make money by selling the call option. So I want to be very clear about this. In this scenario, you cannot lose money by selling the call option. So you could lose money on your stock, but you cannot lose money on the sale of the call option. It is guaranteed money. Even if you're a beginner, you will make money by selling the call option. But there's a trade-off. The bad thing is, when you sell the call option, you are limiting your upside potential if your stock goes up. So don't worry, I'm going to draw this out for you. I'm going to be very clear about this. I'm going to show you the math. Now, I want to clarify this for you. In the previous examples, we were dealing with call options and you are the buyer. We're still going to be dealing with call options, but in these examples, you will be the seller. There are 3 scenarios where you sell call options. Scenario number 1, you buy a call option and then you sell it. Scenario number 2, you sell a call option. And scenario number 3, you buy a stock and then you sell the call option. This is a covered call. So let me explain to you a covered call and how you make guaranteed income. And we're going to use a real life example, a real stock, the real price, the real call option prices. I thought that this would be best because I want to show you that this entire conversation is legit. We're going to be dealing with Intel stock, ticker symbol INTC. At the time of making this video, Intel is at $32 a share, a little bit over, but we'll call it 32 to make it easy. And we're going to use the Intel call option that expires in about 2 months. And that call option, with a $34 strike price, is selling for $1.50. So again, what I'm showing you is a real life example. So these are actual numbers. Keep that in mind. That's important because you're going to see how much money you can make and it gets kind of wild. Okay, so here's the situation. Let's say that you buy Intel at 32 and I give you an offer. So I, Brian, want the option to buy Intel from you at $34 within the next 2 months. So if you're going to give me that option, then you're not going to give me that option for free. So you're going to tell me, okay, Brian, if you want that option, then it's going to cost you $1.50. And I tell you that, okay, you got yourself a deal. Let's do it. So I pay you $1.50 to have that option to buy Intel from you at $34 within the next 2 months. So in other words, you sold me a $34 call option that expires in 2 months for $1.50. Okay, so why would I do this? Why would you do this? Let's work out 4 scenarios and I'll show you the math. So scenario number 1, the share price of Intel goes down. So you bought Intel at $32 a share. And let's say that in 2 months, Intel falls in price by $2. It goes from $32 to $30. So in this scenario, I'm not going to use the call option that you sold me because why would I buy Intel from you at 34 when I could just buy it on the open market for 30? So in this scenario, you sold me a contract that turned out to be worthless for me. Okay, so for you, Intel falls from 32 to 30. You lose $2 on the stock, right? But you made $1.50 by selling me the call option. So you hedged and you're only down 50 cents instead of $2. So it's a good thing that, well, in this scenario, that you sold me the call option. Moving on to scenario number 2, the share price of Intel does nothing. So you bought Intel at 32. After 2 months, it's the same. Nothing happened. It's still at 32. In this scenario, you didn't make money. You didn't lose money on the stock. The price stayed the same. But you sold me the call option to buy Intel from you at 34. And I paid you $1.50 to have that option. But I'm not going to exercise that option because I'm not going to buy Intel from you at 34 because I could just buy it on the open market for 32. So in this scenario, congratulations to you. Your stock did nothing and you made $1.50. And let me tell you, making $1.50 in this type of transaction in 2 months is not bad because $1.50 divided by 32, which is what you paid for Intel, that's a gain of 4.6%. So you made a gain of 4.6% in 2 months. So if you annualize that, that's a rate of return of 28%. And again, these are real numbers. So this is how awesome options are. And the results get even better in the next scenario. So I'm going to show you. Scenario number 3, Intel goes up by a little. So you bought Intel at 32. Let's say that Intel goes up from 32 to 33. In this scenario, you made money on the stock because Intel went up from 32 to 33. Additionally, you sold me the call option to buy Intel from you at 34. But the share price of Intel is at 33, so I'm not going to exercise my option because even though the stock price went up, I would rather buy Intel in the open market for 33 rather than buy it from you for 34. So this is an awesome scenario for you because you made $1.50 by selling me the call option and your stock went up by $1. So you're up $2.50 in 2 months. That's a 7.8% gain in 2 months. Annualized, that's a rate of return of 46.8%. Scenario number 4, the price of Intel shoots up. So you bought Intel at 32. Intel shoots up, let's just say from 32 to 40. So you have to remember that you sold me the option to buy Intel from you at 34 within the next 2 months, and it shot up to 40. So you know what I'm going to do? You know what I'm going to do with the call option that you sold me? I'm going to use it. I'm going to exercise it. I'm going to buy Intel from you at 34, and I'm going to sell it on the open market for 40. So even though the price of Intel shot up to 40, you are forced to sell it to me for 34. So that was the contract. That was the deal. I paid you $1.50 for that option. So you bought Intel at 32. You sell it to me for 34. So you make $2 of gain on the stock, and I paid you $1.50 to buy that call option from you. So you make $1.50 there. You walk away with a gain of $3.50 in total. That's an 11% gain in 2 months, annualized. That's a rate of return of 66%. That's pretty awesome. Now, with that being said, I want to ask you a question, and just think about this honestly. Would you be upset if this happened to you? Because you made an 11% gain in 2 months, but if you never sold the call option, then your stock would have went up from 32 to 40, and you would have an $8 gain on the stock. But you did a covered call, and you made a total gain of $3.50. So you sold yourself short. You still made money, but you would have made more money if you never sold me the call option. But of course, you didn't expect the share price to go up so high so quickly. So I guess it's just a matter of your point of view, whether you'd be kicking yourself or not over the situation. But that is the risk of writing a covered call. Again, you cannot lose money by selling the call option. The downside is that you are limiting your upside potential. Okay, so I hope that you're still following along. I hope that this is all clicking. But I have to show you two very important variables with covered calls: the strike price and the duration. But first, if you're finding this helpful, please give this video a thumbs up. I'm just trying to be helpful. If you can help me with a like, I'd appreciate it so much. And thank you very much. I appreciate it. Now, let's modify the variables and see how the numbers work out. Let's change the duration of the contract, which is the expiration date of the call option. So the $34 call option 2 months out is selling for $1.50. But what if we changed the duration to 6 months out? Now, I want you to know this. The more time the call option has, the more expensive the call option will be. And that means that you as the seller would collect more money. So let's look at the call options on Intel 6 months out instead of 2 months. And here are the prices for the call options 6 months out. As you can see, the $34 call option 6 months out is selling for $2.61. So if you sell that call option, then you would receive $2.61. But here's the thing. You may be thinking, okay, but you can sell the $34 call option 2 months out and make $1.50. So over the next 6 months, why not just sell the $34 call option for $1.50 every 2 months? That way, you'll make $1.50, $1.50, $1.50, and then after 6 months, you'll end up with $4.50. So that sounds better than selling a single call option 6 months out and making $2.61, right? So that would be true if 2 months from now, the $34 call option were still selling for the same price at $1.50. And then 2 months after that, if the call option was still selling for $1.50. So in that scenario, yes, you would make more money by selling a 2-month option and then another 2-month option and then another 2-month option instead of selling a 6-month option. However, the price of the call option is constantly changing. If the stock price of Intel falls from 32 to 28, the $34 call option 2 months out would probably sell for around 50 cents or even less. So that's the risk that you're taking by going with a shorter call option. If you lock yourself into a longer call option, then you know how much you're going to make in 6 months. If you go with shorter time frames, then you don't know how much that $34 call option will be selling for when the time comes. You may get a better price, you may get a worse price, so that's the risk. Now, let's change another variable. Let's change the strike price. So you can sell the $34 call option 2 months out and make $1.50. Or we can change the strike price to 38 and sell that option for 50 cents. If you go with a higher strike price, then you're giving yourself more upside potential to make money on the stock in the event that your stock goes up. So just think about it. You're guaranteed 50 cents in 2 months' time. If Intel shoots up to 38, sure, you're going to make less money by selling the call option because you're only going to make 50 cents instead of $1.50. But you're going to make more money from the stock going up. Because if Intel shoots up to 38, you're going to be forced to sell Intel at $38. But if you sold the $34 call option, then you would be forced to sell Intel at $34. But you probably realize the downside. If you bought Intel at 32 and it did a whole bunch of nothing, let's just say that after 2 months, it stayed at 32. Well, if you sold the $34 call option, then you could have made $1.50. Instead, if you sell the $38 call option, then you're only going to make 50 cents. So that's the dilemma. So for the call option, the closer the strike price is to the current price, the more expensive the call option becomes. The farther the strike price, the cheaper it becomes. Okay, now let me show you how to write a covered call. In order to write a covered call, you need to buy the stock first and then sell the call option. So do not buy a crappy stock because you don't want to make money by selling the call options but lose money on the stock. So that's like dropping quarters to pick up pennies. So find a good stock that you think will go up. And if you remember, with options, you're dealing with 100 share increments. So in this Intel example, in order to do a covered call, you need to buy 100 shares of Intel first, and then you sell the call option. So let's just say that you already own 100 shares of Intel. In this scenario, you would just place a single order. Sell to open, one contract, select the expiration dates and the strike price, the price of the option, and that's it. Piece of cake. Very easy. If you have 500 shares of Intel and you want to write covered calls on all 500 shares, then it's going to look like this. Sell 5 call options. And just so you know, you don't have to write covered calls on all your stock. If you have 500 shares of Intel, you can write 1 contract, you can write 3 contracts, whatever you want. And you're going to notice that it says $750. That's how much money that you're going to make from selling 5 covered calls. So here's the math. The $34 call option is selling for $1.50. So that's $1.50 a share. Multiply that by 100 shares, and that's $150 for each call option contract. Multiply that by 5 call options that you're selling, and you make $750. $150 a contract times 5 contracts equals $750. So as I said to you before, you need to buy the stock first and then sell the call option. But I want you to know that many brokerage accounts will allow you to buy the stock and sell the call option at the same time. So it'll be simultaneous. So it would look like this. You're completing 2 actions at the same time. Buy the stock, sell the option. Now, let me finish by telling you what happens after you write the covered call. As soon as you sell the call option, you receive that money immediately. So if you sold the $34 call option 2 months out for $1.50, which would equate to $150, then you would receive that $150 in your account immediately. So it's automatic. It's going to appear in your account. It's going to appear there like magic. So you don't have to do anything. Now, after 2 months, let's say that the price of Intel ends up at 35, which is above your $34 strike price. Then you would be forced to sell your Intel stock at 34. And your Intel shares would be sold automatically. You don't have to do anything. They take care of it for you. If the price of Intel ends up below 34, then the call option that you sold expires worthless and it's automatically eliminated. So you don't need to do anything. Your brokerage account takes care of everything for you. And you have to remember that you got paid upfront for selling the call option. Now, I want to give you these last tips. The premium is a fancy way to say the price of the options contract. So if the $34 call option is selling for $1.50, then $1.50 would be the premium. If you're selling the option, the more premium, the better, because as the seller, you want to get paid more money for writing the contract. In terms of how options are priced, I want to explain this to you in a nutshell. More time on the contract means more premium. The closer to the strike price means more premium. The more volatile a stock is means more premium. So regarding volatility, this makes sense because just think about it. If a stock is going up or down like crazy, then you deserve to be compensated more for locking yourself into a contract at a certain price. Because who knows what's going to happen to the stock within your duration. So when you're looking to write covered calls, make sure that the deal makes sense. Because you have to remember, the downside is that you're limiting your upside potential during the contract's duration. So if the risk is not worth the reward, then don't do it. I know that the appeal of guaranteed income is great, but if it's not worth it, just don't do it. Use your best judgment. I trust you. And if you want to find good covered calls, it's like shopping. You have to shop around for good deals. Sometimes there won't be any good deals. Other times there will be a lot of good deals. So usually there are a lot of good deals on a lot of good stocks. Just use your best judgments and you'll get the hang of it. I hope that this has been helpful, and I want to tell you this. If you need to rewatch certain parts, please do so, because that is normal and that is expected. I'm just happy that you're taking the time to improve yourself and learn this to become a better investor, because this is going to be a game changer and it's going to give you more opportunities to make more money. We are now moving on to put options, and put options will be you can think of it as the complete opposites of call options, but I'm going to break this down for you nice and easy. I will explain to you what are put options, how you can make a lot of money with put options, and how you can lose a lot of money with put options as well. So let's start from scratch. What is a put option? A put option is a contract between a buyer and a seller. So let's pretend that I'm the seller and you are the buyer. So in other words, I am selling the put option and you are buying the put option. Now let's choose a stock. Dave & Buster's stock, ticker symbol is PLAY, play. Dave & Buster's is currently trading at $44.96, but to make it easier, let's just say it's $45 a share. And I want to make a deal with you. What if I told you within the next month, I will give you the option to sell Dave & Buster's stock to me for $40 and I'll buy it from you. So you don't have to sell it to me, but you can if you want to. That is your option. But I'm not going to give you that option for free. If you want that option, you'll have to pay me 45 cents. And let's just say that you agree, you'll pay me 45 cents to have that option. So ultimately, you bought the Dave & Buster's $40 put option with a 1-month expiry for 45 cents. So it sounds fancy, but it's very straightforward. But you have to remember that right now, Dave & Buster's is at $45 a share. So you're not going to go buy it for $45 and then sell it to me for $40, because if you did that, then you would lose money. You would lose $5 a share, so you wouldn't do that. So the question is, how do you make money? So you want Dave & Buster's stock to crash within the next month. If Dave & Buster's stock falls to, let's just say $30 a share, then you would be so happy. Because if Dave & Buster's falls to $30 a share, then you can buy Dave & Buster's on the open market for $30, and then you could immediately sell it to me for $40. And then you would make a gain of $10 a share. And you have to remember that you paid 45 cents to have this option. Therefore, your true profit would be $9.55. So that would be an awesome rate of return, because with 45 cents, you made $9.55. And I want you to know that this is a real life example. Those are real numbers. Take a look for yourself. This is the options chain for Dave & Buster's, ticker symbol PLAY. We go about 1 month out, we open that up, and you get this. So don't be intimidated. This is very easy to read. So we're looking at the $40 put option that's selling for 45 cents. You refer to the ask at 45 cents because if you're trying to buy the put option, the seller is asking for 45 cents. So you look at the ask. Now let me give you a different example to show you how you lose money. So let's just say that you bought the same put option. You bought the $40 put option expiring in 1 month. If Dave & Buster's does not fall below $40 in a month, then your contract will be worthless. So to demonstrate, Dave & Buster's is at $45 a share. Let's just say that the stock falls to 41. Then in this situation, your contract would be worthless. Because why would you exercise your option to sell it to me for 40 when you can sell it on the open market for 41. So if the stock does not fall below your strike price before the expiration, then you wasted your money on buying the put option. So in this example, you paid 45 cents for nothing and wasted your money. Now, I need to tell you about the duration of the contract, and I'll teach it to you like this. I'm going to give you two offers, and you tell me which one sounds better to you. Offer number one, you can sell Dave & Buster's stock to me at $40 within the next month. Offer number two, you can sell Dave & Buster's stock to me at $40 within the next 5 months. So you tell me which offer sounds better to you. And it's going to be offer number two. Offer number two sounds better because you have more time for Dave & Buster's stock to fall below 40. However, this favorable condition, it's taken into consideration, and I'll show you. So take a look for yourself. Here are the options contracts on Dave & Buster's. For the put option 1 month out, the $40 put option is selling for 45 cents. Now, I want to show you the same $40 put option, but 5 months out. So we open that up and we see this. The same $40 put option is selling for $2.40, which is a big difference compared to 45 cents. So regarding the duration, the more time on the contract, the more valuable the contract is, so the more expensive it is, time equals money. So you can check the same $40 put option that expires in a week, and you're going to see that the contract will be cheaper. You can check the same $40 put option that expires a year and a half from now, and that will be much more expensive. Now, I want to tell you about the strike price. I'm going to give you two offers again, and you tell me which one sounds better to you. Offer number one, within the next month, you can sell me your Dave & Buster's stock for 40. Offer number two, within the next month, you can sell me your Dave & Buster's stock for 45. So which offer sounds better to you? So in this situation, of course, offer number two is going to be better for you because you would rather have the option to sell me Dave & Buster's stock at a higher price. However, this is also taken into consideration, so take a look for yourself. This is the put option 1 month out. The $40 put option is selling for 45 cents. The $45 put option is selling for $1.90. The higher the strike price, the more valuable the put option is. So compare that to the $35 put option, which is selling for 15 cents. Therefore, a higher strike price is more expensive and a lower strike price is less expensive. Now, I want to remind you that with options, you're dealing with 100 share increments. So if you buy the Dave & Buster's $40 put option for 45 cents, then you are buying the option to sell 100 shares of Dave & Buster's at $40 a share. And that put option will cost you $45 because that put option costs 45 cents a share multiplied by 100 shares equals $45. So if you want to buy the Dave & Buster's $40 put option expiring 1 month out for 45 cents, this is how you do it. The stock symbol for Dave & Buster's is PLAY. Buy to open because you're buying a put. You're buying one contract. You choose the expiration dates. You choose the strike price, and you're buying a put. The price of the contract is 45 cents. But remember, you're dealing with 100 share increments, so it costs $45 to buy the put option. Now, if you want to buy 10 put options, you would just change the number of contracts to 10. And that would come out to $450 in total. That's because each contract costs $45 and you're buying 10 of them. Last thing I want to tell you is this. Let's say that you buy the Dave & Buster's $40 put option and the stock falls to 30. You don't literally have to go out and buy 100 shares at 30 and then use your put option to sell your 100 shares at 40. You can just sell the put option itself as if you were selling a stock. And this is what it would look like. Sell to close. If Dave & Buster's falls to 30 a share, the $40 put option would trade for around $10. So you would type in the price that you want for the put option, no different than selling a stock, and you would make $1,000 per put option. That's because you make $10 a share multiplied by 100 shares, which equals $1,000. And remember, you bought the put option for 45 cents. So the put option cost you $45. And now you can sell it for $1,000. So you probably realized two things. Number one, if things work out well, then you can make a lot of money. But number two, if the stock price doesn't cooperate with you in your given time, then you lose. Now, this is very important. What I showed you is the most basic way to utilize a put option. But this is not the only purpose of a put option. Now, in our next segment, I'm going to show you how to use put options to decrease your risk and generate passive income. So you can do this with cash secured puts. Let's say there's a stock at $10 a share and you think that it's a good buy at 10. But you can create a situation where you can buy that stock for 9. And if it turns out that you can't buy it for 9, then you will get paid some money. So essentially with a cash secured put, you can buy the stock at a discount. And if you can't, then you're going to walk away with some money. Now, if you think that sounds too good to be true, it's not. I'm going to show you the good and the bad with cash secured puts. So personally, I believe that the pros outweigh the cons, but I'm going to show you both sides of the story and you can be the judge. So we're using a real life example. Let's use ticker symbol SIRI, which is Sirius, the satellite radio company. So Sirius is currently at $4.89 a share. And let's say that you think that it's a good buy at $4.89 a share. So you can buy the stock at $4.89 and just hope that it goes up. So that's one way to make money. But another option is that you can do a cash secured put. So here's what happens. Essentially, you sell a put option. By doing so, you lock yourself into an agreement as follows. Sirius is at $4.89 a share. Within 1 month, if Sirius falls to $4.50 or below, you will buy Sirius for $4.50. And it doesn't matter if Sirius goes to $4.50, $4.49, $4, or $3. If Sirius falls to $4.50 or below, you will buy Sirius for $4.50. But within 1 month, if Sirius does not fall to $4.50 or below, then you will not buy it. However, regardless of which scenario occurs, you will be paid 32 cents for agreeing to this. Therefore, regardless of whether you end up buying Sirius for $4.50 or not, you will be compensated 32 cents. Now, I'm going to walk you through 3 scenarios and you'll see how this plays out for you. And you'll see the pros and cons of a cash secured put, and keep in mind that these are real numbers, so you're going to see how much money that you can make. But first, let me show this to you so that you know that these examples are legit. These are real numbers. So we're using Sirius, SIRI, which is at $4.89 a share. Here's the options chain for Sirius. And we're going to use the options that are expiring in less than 1 month. It's in 22 days, but we'll just call it 1 month to keep it simple. And here are the prices on those 1 month options contracts. So take a look at the $4.50 put option. Those are selling for 32 cents. So keep this in mind that we're using real numbers in our examples. Scenario number 1, SIRI stock stays above $4.50. Now remember the deal. SIRI is at $4.89. If SIRI falls to $4.50 or below in 1 month, then you are obligated to buy SIRI at $4.50. But if it doesn't go to $4.50 or below over the next month, then you will not buy SIRI. In this scenario, SIRI stays above $4.50. So Sirius could go up. It could go up from the current price of $4.89 to $6. Or SIRI could do nothing from $4.89 and stay at $4.89. SIRI could go down a little bit from $4.89 to $4.51. Regardless, in any of these events, the price remains above $4.50. Therefore, in this scenario, you do not end up buying SIRI stock, but you still get paid 32 cents. So if you think about it, you did really well. Nothing happens, you didn't end up buying anything or doing anything, and you made 32 cents. But what was the risk here? The risk was that you could end up buying SIRI for $4.50. And what was the reward? 32 cents. So if you make 32 cents by risking $4.50, That is a return on investment of 7.1% in 1 month. That is an annualized rate of return of 85%. And remember, these are real numbers. Scenario number 2, SIRI stock falls to 450 or below. So let's say that after 1 month, Sirius falls to 440. In this situation, you are obligated to buy SIRI for 450. And because you buy SIRI for 450 and it's fallen to 440, you are down 10 cents. However, you have to remember that you were paid 32 cents to take on this deal. So in reality, you bought SIRI for 450, but if you factor in the 32 cents that you were paid, then you really bought SIRI for 418. And if the price of SIRI is at 440, then you're actually at a profit of 22 cents. But I want you to put this into perspective, because remember, when you saw SIRI at 489, you liked the stock and you thought that it was a good buy at 489. But by going with a cash secured put, you bought SIRI for 418. So you got a much better deal on the stock. You got in at a 15% discount. And remember, we're dealing with real numbers. So this is why a lot of investors love cash secured puts, because they pick a stock that they want to buy and they get to buy the stock at a discount. And if not, then they're going to walk away with some money. So it's a win-win situation. But I want to tell you the danger of a cash secured put. I want to show you the nightmare scenario. So here's scenario number 3, SIRI stock plummets. So SIRI's at 489. And remember the deal. If SIRI falls to 450 or below, you are forced to buy it at 450. In 1 month, if SIRI plummets to $1, you will be forced to buy SIRI for 450. So yes, you did get paid 32 cents for making this deal. So your true purchase price is 418, but still, the stock fell to $1. This means that you are down $3.18, which means that you're down 76%. So here's my recommendation. If you're thinking about doing a cash secured put, I would recommend doing it on a stock that you think is already a good buy. But you have to put things into perspective. So if you thought that SIRI was a good buy at 489 and you bought it at 489, if it falls to $1, then you would be down 79%. If you do the cash secured put, then you would be down 76%. So even though this is a nightmare scenario with a cash secured put, it's not like you would have been spared or done any better if you bought the stock outright. But I want you to still be aware of the danger. Now let me show you how to execute a cash secured put. So it doesn't matter which brokerage account that you're using, they'll all be similar. You go to trade options, and then you'll see an order screen that looks similar to this. In order to create a cash secured put, you will place a single order. And then you choose the ticker symbol of the associated stock. In our example, we're using Sirius, ticker symbol SIRI. We're going to be selling the put option, therefore we select sell to open. You choose how many put options that you want to sell. In our example, we're selling 1 contract. But remember, 1 contract is equivalent to 100 shares of stock. You'll select which put option you're selling. In our example, it's the put option expiring on August 18th. So this was the put option expiring 22 days out. You select the strike price. In our example, we used the $4.50 strike price. And of course, we are selling a put option, so we select put. I would recommend doing a limit order because if you do a market order, you could end up selling the put option for a bad price. And fill in how much you want to sell the put option for. In our example, 32 cents was the going rate, so I'm just going to use 32 cents. And remember, 1 put option equals 100 shares of stock. That's why you'll receive $32 for selling 1 put option. Because if you sell 1 put option, you receive 32 cents per share. And 32 cents multiplied by 100 shares equals $32. And time in force, I filled in day. This means that if the order doesn't fill today, then it's going to cancel itself automatically. You can switch this to good till canceled, but that's up to you. So I told you, it's very easy and straightforward to execute a cash secured put. In a separate video, we'll cover how to shop around for good deals on cash secured puts. So this is something that you'll get better at with experience. Now, I want to tell you this. If you made it this far, then I know for a fact that you are serious about becoming a better investor. So I encourage you to please check out our website. I'm going to leave a link for you down below. I'm always looking for good options. I'm always looking for good deals. So please stop by. Thank you so much. Please subscribe, and I wish you a very nice day. Happy investing.